Self-employed homebuyers apply for the wrong mortgage type, and it's the reason they keep getting declined. Traditional mortgages are more geared towards W-2 employees, and if you're self-employed, you got to apply a different set of rules. If you keep applying with the wrong mortgage products, you're going to keep getting declined, or worse yet, settle for something you actually didn't want. I'm Andrew Russell, owner and founder of RCG Mortgage, and one of my specialties is getting home purchasers into the homes of their dreams in the right mortgage products, especially if they're self-employed, without getting soul-crushing denials. One of my clients, Anthony, his wife actually called him Antony, but I digress. He owned a very successful chiropractoring business. Leave a comment down below, guys, if you know the right way to say it. So he owned a chiropractor. We're going to go with that business. And he was killing it. Business was great. He was making 6 figures a month in revenue to his company. And it turns out he was referred to our team after he was in contract to buy a really nice house right on the water, and he got declined by the bank where all his money was at. And another similar big bank, he submitted an application, and he was declined twice. He didn't know why. His real estate agent said, hey, listen, you got to talk to Andrew and his team. They specialize in different types of loan products. We spoke to him. We got the exact same documentation, which I knew exactly what it was going to look like. And we got his last 2-year tax returns, and he had a corporation. And nonetheless, he was making, like I said, it was like hundreds of thousands of dollars a month of revenue, millions a year in revenue. But the big banks and conventional mortgage types or jumbo mortgage types, they look at your net. So he gave himself a salary, but he only gave himself $120,000, which sounds great, but wasn't enough to qualify for a second home on the water. And all the business revenue, after all the expenses on his corporate return, it actually showed a small loss, believe it or not. So he was always right out of the gate. He was dead on arrival from a mortgage approval perspective, which is crazy because he actually made an offer to buy this property thinking my you-know-what doesn't stink. He didn't even have a pre-approval. The buyer agent knew the listing agent, said my client knows a successful chiropractor business, and without a doubt, we'll have no problem getting a mortgage. Well, turns out that was actually a big mistake, which is why you always need a pre-approval. So what I said, I took a step back and said, hey, Anthony, do me a favor. Send me your last 12 months business bank statements. The full doc, the more typical conventional route's not going to work for you. Let me look at your last 12 months of business bank statements. Let's take a look at the cash flow, how much revenue is coming in, and see month over month if there's a lot of volatility or it's typically, within similar revenue deposits every month. We added it all together. I think it was something like, $2.5 million for the year. If you added all the last 12 months, he was the 100% owner of the business, which is amazing. So right away, that $200,000 of revenue a month, because he's a 100% owner, he gets credit for that. We take a 50% expense factor, which that $200,000 turns into $100,000 of usable income. And if you do the math, if he went the normal route, which he tried twice with big banks, they were giving him credit for $10,000 a month of income, which is $120,000 salary divided by 12. We were giving him credit for $100,000 a month of income, which is 10 times the purchasing power. There's absolutely 100% no catch. He was just in the wrong mortgage type. He was putting 20% down on an amazing property. It's just the way income is looked at and ascertained or figured out with a conventional mortgage is very different than a bank statement program. So we're able to get the contract and kind of do a rush, use the appraisal that he already had done with the big bank, and close in something like 21 days, and it was an amazing story. He's still one of my friends, big Jet fan. But I hear you say, hey, Andrew, that sounds all great. Anthony's probably super psyched, but how much higher was that interest rate? I'm sure it's predatory. Believe it or not, the interest rate that was being offered to him from the big bank, when I took in the application, there was a little bit of a market rally too. A little bit of luck was behind us. We were able to offer the same 30-year fixed interest rate. There was no difference. So the rate actually in this case was the same. And guys, there's never that much of a difference, 1/4 or 0.5% in rate. But are you willing to sacrifice 1/4 or 0.5% in rate to actually close on a home? Of course you are. And I hear you now. Hey, Andrew, clearly there's something wrong with this mortgage type. It's illegal. They're going to get in trouble, right? If they write off all these expenses, how do you say this is the type of income they make? Well, my old pappy used to say, he who has the money to offer makes the rules. So it just has to do with the agency or the mortgage company that's offering the money to the client. At way number one, we're going to look at your tax returns. We're going to look at that, that whole set of forms, look at the net. That's what we're going to use to base your income off. Or with the non-QM, with the bank statement programs, the lenders and the underwriters say, hey, listen, we don't want that stuff. The way we figure what this person actually makes and can afford a month is the monthly revenue. What percent of the business do they own? And then from there, conservatively, they take half of that monthly revenue if they're 100% owner, and that's what they use for the income. It's the best loan product for self-employed clients. When it comes to determining which option makes the most sense when you're a self-employed client looking either to refinance or to purchase, we deploy a three-pronged process to determining which loan product makes the most sense. I call it our 1, 2, 3 punch for self-employed. Now, the first option, first right of refusal always goes to a conventional mortgage. Now, don't assume just because you have a great credit score, let's go to 740 or above, and you're putting a big down payment, or if you're doing a refinance, you have a great credit profile and mortgage payment history, that you're going to qualify. Because the fact of the matter is, when you're self-employed, typically we see clients don't qualify, which is number one, and number two, at the pre-approval side, they just don't qualify and they just dead their house search and stay a renter. Now, why is this? Think about it. If you're self-employed, if you're listening right now and you're self-employed, you're typically filing a Schedule C, a sole proprietor, or a single member LLC, or S Corp returns, C Corp returns, partnership returns. Now, if you ever look at a tax return and you see a business or your business that has a lot of revenue coming in, sounds great. You think you're killing it. You got 2 commas, I don't know, maybe even 3 comma club, but we don't go off of the revenue. The lenders on a conventional loan, the underwriters don't go off of that revenue, unfortunately. It looks cool, but it's all for show. They go off of your net profit. Now, sometimes out of the revenue, the owner or you as a self-employed business owner will take a salary, which of course we could use, but we're also going to look at the net, the bottom section of the return. So you take, as an example, the $2.5 million for the yearly revenue, as in the case of Anthony, the chiropractic team, and he wrote off all his other employees. He had a really expensive space of where he had clients go to. I think he wrote off all of his cars. He had a lot of stuff from an expense perspective. Now, why did he do that and write that all off? Of course, he wanted to take his revenue, his money, and write it down so the net profit he showed to the IRS, of course, he wants to pay the little in IRS tax liability as possible. But unfortunately, lenders, we go off of that bottom number. So that $2.5 million, he had a $120,000 salary. The net profit shown after all the expenses was actually a loss. So because of that $10,000 a month in salary actually was lowered a little bit by the loss, which was taken annualized, turned into a monthly negative number, and it just wasn't enough to qualify. So of course, the first option is we always look at a conventional mortgage. Typically has the best interest rates, the best options, lower down payment options. But unfortunately, when you're self-employed, it almost seems to never get the job done. The second option is, and what we've seen to price almost similar to a conventional loan, depending on credit score and qualifications, is the bank statement program. Now, again, imagine you have a yearly revenue number of about $2.5 million. Let's call it $200,000 a month of revenue. Now, we don't look at tax returns. As a matter of fact, we don't even ask for them. Maybe we looked at them initially and realized in our 1, 2, 3 strategy, option number 1 didn't work. So now we're on to option number 2, which is the bank statements. We'll ask for the last 12 months. Sometimes you look at 24 months. It gives a little bit better pricing, just more paperwork. And people in this day and age love as little as possible. The fastest way from A to B, from a pre-approval or an approval to closing is as little paperwork as required. So we only ask for 12 months typically. We'll look at the 12 months. We'll add together each month. We'll look at the deposits and the revenue and make sure within reason it's always similar, not big variances where it's $200,000 one month, $20,000 the next, $0 the next, $400,000 the next. That's super volatile. They want to see revenue consistency. And as long as it's similar, we will add it all together and get that yearly number. Now, you take that yearly number, call it 2.5 million. So you divide it by 12, it's a little bit more than $200,000 a month. Now, no, you don't get credit for $200,000 a month. We say, hey, what percent of the business do you own? So say it's 100%, it's still $200,000 a month. And then from there we say, hey, just instantly right out of the gate, we're going to take half off, assuming an expense factor of 50%. I didn't create the rule. The lenders, the underwriters, the non-QM lending space has created this as the guideline, which is super cool. No tax returns. And they're going to, if you're a 100% business owner, take half off the top and bam, that's what you get credit for income. And so in this case, $200,000, 50% of that is $100,000, and that's what we're going to use as income. Now, it sounds great. With these self-employed programs, typically they want to see 20% down on a purchase. Typically, they want to see 20% or more in equity on a refinance. You can do 15 or 10% down on a purchase. Rate gets really spicy, folks, really spicy. Say the going market rate 7%. You could land into the 8s or 9s if you put less money down. So to me, it's a little bit more of a ripoff. 20% is the rage right now for a self-employed purchase or doing a refinance. We have 20% in equity, 80% financing or less. That's ideal. They're also going to want to see higher credit scores than a conventional mortgage. Typically a 680, 700 just gets the job done. So they want to see a great profile because, again, they're taking a little bit more of a risk, contemporarily speaking, versus a conventional mortgage and how they review income. So they're going to want to see that. And there's something called reserves. You can buy a $600,000 house and put 20% down, get a conventional mortgage. And if your cash to close is $100,000, all you need is $100,000. You don't need a penny more. When it comes to a non-QM bank statement purchase, they're going to want to see something called reserves. Reserves are, what's your mortgage payment? Say your mortgage payment's $5,000. If you close and have $5,000 left to your name, that's 1 month reserves. If you close and have $30,000 to your name, that's 6 months reserves. Now, typically on these programs, they want 6 or even 12 months, a full year worth of mortgage payments left in the bank for a rainy day. Now, they don't do anything to it. They don't touch it. They don't take it and put it on red in Vegas. They just want to make sure if the you-know-what hits the fan, especially in your business, that you have enough money in the bank, liquidity, to make that payment. Now, doesn't this sound great? It's so much easier. Like, you are self-employed, you may not even want to qualify or try to qualify for a conventional loan. But sometimes, even for self-employed with that amount of revenue, say our chiropractor, maybe that number or that loan program doesn't make sense or doesn't work. And how could that not work? Because, again, if you remember, we look at the bank statements, we look at the money coming in, and we want to see that it's consistent. So say, for instance, say this chiropractor team did so well, but he had work-life balance, and 4 months out of the year, 2-month chunks times 2, he brought his family to Greece and lived the dream. So that means if he kills it for 4 months, takes 2 months off. Kills it for 4 months, takes 2 months off. The lenders are going to see in the bank statements, it's going to go from hundreds of thousands, 100,000 to zero. Hundreds of thousands, and if that's how his business ran, and there's plenty, sometimes landscaping is very cyclical depending on the time of year. We're going to see a big amount in revenue. It's not going to seem consistent, and a lender is going to deny them even on the bank statement program for inconsistent revenue. Now, the third option in our 1, 2, 3 strategy is the P&L program. Now, the P&L program does not review bank statements. It's going to get a profit and loss. So in his case, over the last 12 months, we're going to look at that yearly revenue, call it $2.5 million. Maybe at the time of doing that profit and loss from an expense perspective, there was only, $200,000 a month in revenue, maybe $150,000 a month in expense. So that leaves about a $600,000 a year, revenue number, give or take. So that should be able to get the job done. Again, we're going to look at the revenue, the expenses on the profit and loss, and then the net. So for instance, if $200,000 a month in revenue, $150,000 is expense, it'll be a $2.4 million revenue P&L over 12 months, about $1.8 million in expense. It's going to leave about $600,000 for profit over 12 months, which is $50,000, which again should get the job done. Now, what's the catch? Rate's a little higher on that than the bank statement program. So again, you have conventional, our first option. Rates are always typically the best. A bank statement program, if they're not similar, they're a little bit higher, quarter, a half, usually not 1%, but that's the range from being higher versus the norm. And then the P&L program, which is again another quarter, half, maybe even 1% higher than the bank statement program. And again, they're not looking at bank statements, they're just looking at the P&L. They're not going to see volatility, but it's really an amazing option. It still gives you a great 30-year fixed rate mortgage and a great program, because at the end of the day, if the P&L program didn't work and you're self-employed, you got nothing left. All right, so check it out, guys. Here's a quick and easy way to determine when you're going to use each in our 1, 2, 3 punch strategy. So if you're self-employed and you're looking to purchase and get a conventional loan, just look at your returns, go over to your accountant and say, hey, listen, how's this profit look? If it's a lot of profit, if you don't write off a lot of expenses, you're good. Proceed as conventional, you should be okay. But if you write off your expenses and your CPA is like, hey, man, that's why you pay me the big bucks, because we have write off all these expenses, then always defer to a bank statement program. The bank statement program is usually going to be the best. We're going to look at the 12 months bank statements, look at all the deposits, see what percent of the business do you own. Typically take about half of that. You can take a little bit more in certain occasions, but typically take half of that for the income, and that's what we'll use. It's typically the best for self-employed clients. And of course, if your business entrepreneur, self-employed business owner, if the revenue is volatile or it's cyclical or it's always up and down, have no fear. The P&L program is the next option we'll defer to, because all it is going to be a basic P&L. If you've seen them, guys, it's like, think of an Excel. You have revenue, you have some expenses listed out, doesn't have to be all that granular, and then a net profit number all over the last 12 months. That's all we use, literally just that. And we'll take that net profit number for the 12 months divided by 12, and that's what you'll get credit for income. Now check it out, guys. We talk about a lot of stuff. So I created a 1-page bank statement program review form for you guys. Hop in the description, the link's there. Make sure you click it. A lot of this stuff, listen, this is what I do for a living. I work with 10,000, probably even more clients at this point. I've worked with hundreds and hundreds and hundreds of non-QM clients. To me, this is what I do for a living. But to you, it might sound a little bit confusing, a little bit convoluted. So check out the link in the description. Click it, get our free guide. You're definitely going to want to use it. If you found this video helpful, you have to check out the next video called The Mortgage Playbook for Self-Employed Buyers. You're actually going to see behind my eyes on my screen, look under the hood, go into the numbers and see what it takes to actually make approvals happen. Make sure you click here, guys. Make sure you click here to check out our next video.